Welcome to Subramani. One question on the top of everybody's mind is why is the market going down? Well, not going down so much in India, but going down in the US. And since we have this almost perfect kind of a correlation, it is bound to go down in India after some time. And the answer is obvious, it is interest rates. So the question is when interest rates go up, do markets go down? The answer is yes. In fact, I'll do a separate video on saying that when interest rates go up, asset prices go down, not markets go down, asset prices go down. So your bonds go down first, your equity goes down, your real estate goes down, gold goes down, everything has to go down. That is because of interest expectations. On that we will speak separately. But in the US, it looks like after Mr. Powell's statement a couple of previous Friday, people thought that he's going to increase interest rate, and sometime in March 23 he'll start reducing interest rates again. But he was very clear in his speech that his topmost priority is to combat inflation, which has to be true for every central banker, because the most regressive tax in the world is inflation, because it hurts everybody. The real super rich don't get impacted because they've got a very high real income, so they are not impacted at all. But at the lower end, people are impacted. So every central government, whether it is Fed or RBI, has to concentrate on making sure that the lowest entity or the weakest entity is not hurt too badly. It will hurt everybody. And the sad part is governments love inflation because it means they need to repay less and less of their debt. So if anybody tells you that the government is combating inflation, the answer is no, it's not true. The ruling party combats inflation because inflation could be a very big vote puller for the opposition parties. So right now in India, 2024 is the election. There are other big elections coming, so we will concentrate on inflation, immaterial of what stand the government says it takes. So it will be a big this big tirade or a big march against inflation, so for all of us. So what is the signal from the US? I think the signal is very clear that interest rates will go up, at least in the short run, and therefore markets will come down. And since markets will come down in the US market will become far more attractive than Indian market. So the money that has left India is very likely to find its way into the US equity market rather than in the Indian equity market. Not to say that the amount of money is limited. So maybe some money will come into India and Indian markets might go up, but immediately in the US interest rates are likely to go up, and therefore markets are likely to remain weak, if not go lower. But what is the signal in the US market? Look, interest rates in the short run have gone up from 2.6 to 3.1, which is a big, huge jump. And inflation in the US is 8, 9, 10%, right? So that is the kind of numbers that we are talking about in the US, which is very high. So therefore, the interest rates in the long run have to go up, right? So if the interest rates are 10%, then why would anybody give money to the central government or to the Fed at anything less than 10%? Well, the long-term interest rates in the US are still only at 3.1%, which means the market is seeing this 10% inflation as transitory. So it's not likely to hit the economy in the long run. So the long run interest rates have not risen, it's just at 3.1, which means the yield curve is flat. It's not really, it's not like this, right? In the longer end, the interest rate should go up. It's more like this, and very slight change perhaps towards the end. So it's very clear that the market thinks it is temporary, but Powell has said clearly that his main focus is now inflation, and therefore his target inflation could be much lower than what it is currently. So in the short run, interest rates will go up. Therefore, the reduction might happen only in September 23 and not March 23. That is the only signal from the market. Now, does it mean you have to do something whether you are in US or in India? Answer is no. You have to continue your SIPs, whatever you are continuing to do, and not have to worry about these interest rates. If you're worried that markets will go down, then you should be lucky that you are going to acquire more units when the markets go down, and that is exactly where your returns get built. So don't worry about the market coming down. All you have to do is to stay put and continue your SIPs. If some of the shares that you have go down and you feel that wow, this is a good opportunity to buy, maybe you should be buying. The impact that higher rates have on the assets is especially those assets which have run up very well. The guys who have bought it feel that let me book some profits, this is not going to sustain. So higher valuation stocks are likely to take a hit, which has already happened in the US. It is the higher valuation stocks which have taken a hit, and also some of the companies which have borrowings and which are paying interest might take a hit. So these are the companies or these are the weak areas where you could take a hit. But Indian conditions are slightly different. India is nowhere near heading for a recession. This is the last thing in our minds. India is still growing. Our infrastructure will grow. Hold on. We have been saying infrastructure will grow for a very long time, right? I have also felt that infrastructure has to grow. But it's not happened in the last 10 years. Whatever the Modi government has to say, infrastructure may have happened, but infrastructure stocks have just not gone up, right? 100 new airports, 100 new colleges, 1 lakh employees in schools, 1 lakh policemen. UP has shown the way. I do not know how many more jobs need to be created in UP itself, right? So all those things will have an impact. The market will do well, but right now the market seems to be weak and there is not enough buying. But infrastructure will happen. Infrastructure is happening. So infrastructure companies, the impact on infrastructure companies is not as much. They are not, I mean, your GTL Infra, your GMR, Larsen and Toubro are not really acted in a big way. But the people supporting the infrastructure, your cements are up, your cement shares are up, electrode shares are up, grinding wheel shares are up. That shows that some industrial activity is happening, but perhaps not enough, right? But we are at a very high capacity utilization, so infrastructure stocks have to do well. I have no clue when, because we have been saying this for a very long time. All fund managers say, oh, infrastructure will do well and therefore BFSI will do well. We are saying this, we've been saying at least for the last 10 years about infrastructure. It's not happening, but it has got to happen. Something has to give, so it will happen. So what does all this mean? It means that Powell has, market moves on expectation. So Powell has made sure that the market expectation is now tempered. People have said, he has said, I'm going to increase interest rates. So people are now assuming that the worst will happen. Will it happen? I don't know, simply because the Fed or RBI are slaves to what happens in the economy. So if the economic numbers start looking good, maybe Powell won't raise interest rates. He has already maybe hit you hard enough for you to have expectation that he is going to increase interest rate. That is good enough to temper the market, right? So that might also bring down inflation. So if inflation is down, he may not increase rates as much as he says he will. What your Fed head or your Mr. Shaktikanta Das say is more an indicator in the short run as to what will happen. In the long run, people's expectation is very clear that they think this inflation is a transitionary even in India. So that is not likely to hit you too badly. If oil prices go down, that might reduce interest rates. So there are a lot of reasons to believe that interest rates might come down, but there are a lot of reasons to believe that interest rates might go up. Both are true, and right now we do not know. Therefore, you see, even in the short run, interest rates are fluctuating. In India, in the longer run, I think you can only still get RBI bonds at 7.4%. Recently, HDFC Bank has raised or is trying to raise 81 bonds at 7.8%. So if they are trying to raise money at 7.8% and knowing HDFC Bank that they must have spoken to some of the people who are going to invest, I think it's very clear message that the gilt, 10-year gilt, Indian gilt is going nowhere above 7.5, 7.6%. If you think it will go to 8, the message from HDFC Bank is no, it's not going to 8, because otherwise they wouldn't get money at 7.8. And these are 81 bonds are really very serious institutional players invest. Very few retail investors do it. So I think the interest rates in India seem to have peaked. I don't think it's going to change much. I don't think inflation in India is so much of a worry. The HDFC Bank 81 is an indicator that 7.8% is the upper ceiling for the 10-year gilt. So I think gilt looks good now. Gilt is perhaps fully priced for all the hikes. Will we see some more hike? Maybe we will, but that is in the very short term, and I think we will start correcting by March 23. So if you don't require money before March 2023, there is no reason for you to panic and sell and things like that. If you want money before March 23, anyway you should not have been in equity, right? And your 6 months money should have been in your bank, right, or in some ultra short bond fund. So given these circumstances, I don't think we have to worry too much about Indian markets. So continue your SIP. Personally, I am invested, but I'm more into direct equities. So yes, I am into a lot of infra companies, etc. But I've been wrong for a very long period of time. Having said that, the companies which I mentioned, I may have a long position or a short position. So just a disclaimer. Thank you.